Hi everyone, today we'll be going over accounts, February-March 2021, paper 3-2, question number 4. This is structured paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours, so we will be attempting to solve each question under 30 minutes. Question number 4 is a part of section A, which deals with financial accounting. So without any further delay, let's get started. The equity and non-current liabilities of WPLC at 31st December 2020 are as follows. Now, for the first part of this question, we need to state two benefits to each of the following groups when a company issues preference shares. The first one is to the directors. Okay. Preference share is similar to that of ordinary shares, which means that preference share is also going to act as a long-term fund for the operation of the company, which is definitely a benefit to the directors. Let's write it down. Long-term fund for the operation of the company. And the second benefit would be that preference share does not really dilute the management control, because preference share is different to that of ordinary shares, and we can basically treat it like a long-term debt because the dividend payment is also fixed. It is a certain percentage, right? So for directors, the non-dilution of management control is definitely a huge benefit. Let's write it down. Does not dilute the management control. Now we also need to write down the benefits to preference shareholders when a company issues preference shares. Now, very first benefit would be that preference shareholders get the first priority in a business, which means that dividends are provided to preference shareholders before providing to ordinary shareholders. That is a huge benefit. Let's write it down. Prior claim of dividend before ordinary shareholders. Like I said before, preference shareholders get a fixed dividend, so it is a certain percentage, right? So dividend for preference shareholders does not really depend on whether the company makes a profit or the loss. That is a huge benefit. Let's write it down. There is fixed dividend. Okay, this concludes the first part of this question. We can now move towards the second one. We are given additional information. Retained earnings at 1st January 2020 amounted to 195,000. During the year 2020, the preference shares dividend 28,000 and the ordinary shares dividend 90,000 were paid. A dividend of 0.05 on each of the ordinary shares was proposed at the end of the year. We need to calculate the profit from operations for the year ended 31st December 2020. Okay, I'm just going to create an extract from our statement of changes in equity. I'm only going to create the retained earnings column. So obviously we start with our opening balance, which is at 1st January 2020. Then we know that we paid out dividend, right? So we paid out preference shares dividend. And we also paid out our ordinary shares dividend. Okay, I'm just going to write in the values as well. At 1st January 2020, retained earnings amounted to 195,000. And preference shares dividend amounted to 28,000. So since we are paying this out, this definitely reduces our retained earnings. So this is a negative balance. And our ordinary share dividend amounted to 90,000. Again, that is a negative as well. Okay, then we are also told that dividend of 0.05 on each of the ordinary shares was proposed. So the key word here is proposed, which means that this dividend is yet not paid. Due to that reason, this will not be included in the retained earnings section of the statement of changes in equity. Now, the next thing that would be included will be the profit for the year. Right, and this concludes our retained earnings. So we can now get our balance at 31st December 2020. Let's have a look above. I think we were given the balance at the end of the year above. Right here. it's at 31st December 2020, and we can see that our retained earnings balance is 252,000. So let's substitute this value. That's 252,000. Okay, now the profit for the year just acts as our balancing figure, right? And whenever we're trying to figure out the balancing figure, we just need to subtract these values from the total. In this case, that's 252,000 minus 195,000 plus 28,000, because that's a double negative, which results in a positive. So plus 28,000 plus 90,000, which results in our profit for the year to have the value of 175,000. But we are asked to calculate the profit from operations, not the profit for the year. And what we know is that profit for the year is the difference between profit from operations and finance charge. All right, so we already figured out the profit for the year to have the value of 175,000. We need to figure out our profit from operations. Now let's figure out our finance charge. Finance charge is basically the interest payments for this year. And interest is charged on our non-current liabilities, right? And we can see it's a 7% 10-year debenture, which means that the interest payment rate is 7% of the value of the debenture. So in this case, the interest charge is the value of the debenture, which is 300,000, times the rate of payment, which is 7%, which we can write down as 0.07, which gives our interest charge to have the amount of 21,000. Now this will be our finance charge. Let's substitute this. Okay, so that's minus 21,000. Now we can easily figure out our profit from operations. That is just going to be 175,000 plus 21,000, which results in the total value of 196,000. Okay, this concludes the second part of this question. We can now move towards the third one. We are told that the market value of one ordinary share at 31st December 2020 was 1.80. And we need to calculate the following ratios to two decimal places. The first one is return on capital employed. Now the return on capital employed is just going to be profit from operations divided by capital employed times 100%. And capital employed is just the sum of equity and non-current liabilities. Alright, we already figured out profit from operations in the above part, which is 196,000. And we now need to divide it by capital employed, which is the sum of equity and non-current liabilities, about which we were given above. So we have our total equity right here and the total non-current liabilities. So we just need to add these two together. That's 1,252,000 plus 300,000, which results in the total capital employed to have the value of 1,552,000. Let's substitute this into our formula. That's 1,552,000 times 100%. So the return on capital employed is going to be 196,000 divided by 1,552,000 times 100%, which results in 12.63%. Now we need to figure out the dividend cover. So dividend cover is just going to be the profit for the year minus any preference dividend divided by the total dividend on ordinary shares. So I'm just going to write it down as ordinary share dividend. Okay, we already figured out profit for the year above, which is 175,000. Let's write it down. That's 175,000. We need to subtract the preference dividend, which again, we've written it down right here. That amounted to 28,000. Let's write it down. And we need to divide it by our ordinary share dividend, which is again given right here to be 90,000. Let's write it down. and this results in the dividend cover to be 1.63 times. This just means that profit for the year after deducting preference dividend can cover our ordinary share dividend 1.63 times. Alright, now for the third one, we need to calculate our dividend yield. And dividend yield is just going to be the dividend per share. And this will be for our ordinary shares. And we just need to divide it by our market value per share. Okay. So our market value per share is given right here to be 1.80. Let's write it down. That's 1.80, and this is times 100%. Now we need to figure out our dividend per share. We know that the total dividends paid towards ordinary shareholders was 90,000. We just need to divide it among the number of shares. Let's have a look above. So right here we can see that the total value for ordinary shares is 600,000 and the nominal rate is 1. And whenever we're trying to figure out the number of shares, we just need to divide our value of shares by the nominal rate, which in this case is 600,000 divided by 1, which again results in 600,000. So we can say that our number of shares is 600,000. So we just need to divide the dividend of 90,000 among these shares. That is just going to be 90,000 divided by 600,000, which results in the dividend per share to have the value of 0.15. Okay. Then we are also told that we proposed a dividend at the end of the year, and this proposed dividend, if we paid this in the next year, it will still be counted as the dividend for this year. So we need to add this value to our dividend per share. So that's 0.15 plus 0.05, which results in 0.20. Let's write down. This results in the dividend yield to be 0.20 divided by 1.80 times 100%, which is 11.11%. Now we can move towards figuring out the gearing ratio. And gearing ratio is just going to be the non-current liabilities plus preference shares divided by the capital employed times 100%. Okay, we already figured out capital employed right here. This amounted to 1,552,000. Let's write it down. Now let's have a look at our non-current liabilities and preference shares. We can see that the total non-current liabilities is 300,000 and preference share is given right here to be 350,000. Let's add these two. So that's 350,000 plus 300,000, which results in the total to be 650,000. Let's substitute this into our formula. That's 650,000 times 100%. This gives our gearing ratio to be 650,000 divided by 1,552,000 times 100%, which results in the value of 41.88%. Now this concludes the third part of this question. We can now move towards the fourth one. We are given additional information. The directors consider that the gearing ratio of WPLC is too high. We can see that gearing ratio is actually 41.88%, which means that 41.88% of our capital employed is the value that we need to repay to outside parties. Alright, now for the fourth part, we need to explain 3 actions the directors could take to reduce the gearing ratio. So the very first one is that we could increase our permanent capital, right? And the very major source of permanent capital is our ordinary shares. So maybe we could issue more ordinary shares in order to increase equity. Let's write it down. Issue more ordinary shares to increase equity. And remember that a major portion of equity is our retained earnings, right? And retained earnings just means that withholding the profit into our company itself. And in order to do so, we could maybe reduce dividend payments because dividend is paid out from our profit itself. And while doing so, we could retain more profits in our company, which could potentially increase equity as well as reduce the gearing ratio. Let's write it down. Let's reduce dividend and retain more profit. Alright, now the third action could be that gearing ratio is high due to the fact that we have more repayments to be made. So that is basically our non-current liabilities and preference shares. So if we are to reduce the non-current liabilities and preference shares, our gearing ratio would automatically reduce. So we can maybe repay the debenture. In that way, we could reduce our non-current liabilities. Let's write it down. Repay debenture. Or we could redeem preference shares so that the preference share value decreases, or redeem preference shares to reduce the non-current liabilities. All right, this concludes the fourth part of this question. We can now move towards the fifth one. We are again given additional information. A director of WPLC considers that both the debenture and the preference shares adversely affect the ordinary shareholders. For the fifth part of this question, we need to advise the director whether or not he is correct. Okay, so debenture and preference shares does not dilute the ownership for ordinary shareholders. So that is a plus point for them, right? Let's write it down. There is no dilution of ownership for ordinary shareholders. But we know that debenture and preference shares require interest as well as dividend payments respectively, right? And that could definitely reduce the profit that could be repayable to the ordinary shares as their dividend. That could maybe affect adversely to the ordinary shareholders. Let's write it down. The debenture interest and preference share dividend reduce the profit available to ordinary shares. Okay, secondly, we could also compare the rate of interest and rate of dividend rate for debenture and preference shares to the return on capital employed, because return on capital employed is basically the percentage of return that we are getting from our initial capital employed, right? And we figured out our return on capital employed to be 12.63%. So if our rate of interest as well as rate of dividend is lower than this, then we can conclude that maybe it doesn't affect our ordinary shareholders. Let's have a look above. Okay, we can see that the preference share capital has the rate of 8% and debenture has the rate of 7%, which both are lower than our return on capital employed. So we could write these down as well. Debenture interest rate (7%) is lower than the return on capital employed of 12.63%. Similarly, preference share dividend rate of 8% is lower than the return on capital employed of 12.63%. So what we can say is that ordinary shares or ordinary shareholders definitely enjoy a higher return. Let's write it down. Ordinary shares enjoy a higher return. And this return is the excess of the interest rate of 7% and the dividend rate of 8%. Let's write it down. That is the return in excess of 7% and 8% belong to ordinary shareholders. And now, based on these factors, we need to advise the director whether or not he is correct. So I would say that he is not correct. The debenture and preference shares definitely do not adversely affect the ordinary shareholders, as they are obviously getting a dividend of 90%, which is way higher than the debenture interest as well as the preference shares dividend. Let's write down our decision clearly. So we could say that the director is incorrect. Okay, this concludes the fifth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.